But welcome everyone who joined a bit earlier. My name is Mike. I'm one of the co-founders of Hummingbot, an open source project that people use to build market making and trading bots. So I've been in the crypto industry for a long time. I've met a lot of people who are trying to create tokens, create liquidity for them, try to navigate the very confusing market making and exchange landscape. And I thought, I should do something kind of, just public and try to share the knowledge I've learned over the years about the market making industry for anyone that just wants to understand what it's all about, anyone who's issuing a token, anyone who's working at a market making firm or an exchange that wants to understand more about the industry. So I think that we're actually expecting quite a few folks for this info session. It will be recorded and posted on YouTube afterwards. So don't worry if you have to drop off early. I do want to make it engaging and conversational and not just me blabbering on. So feel free to just drop your links in the chat in terms of kind of like what your questions are. But I'm going to assume some prior knowledge here because I'm going to kind of whiz through topics like the different types of exchanges, kind of like the differences between kind of like meme coins, VC coins, and equities. Okay, let's get started. First, let me go through a bit of introduction about Hummingbot and myself, and then I'll kind of go over what I think is I'll describe what the job of a market maker is, because I think it's important that we all understand, what market makers do, and how they actually kind of make money, how do they serve their customers before anything else. Next, I'll try to cover garbage truck outside. So next I'll try to cover the exchange landscape. So what does it look like right now? What are the different types of exchanges that people want to trade on? And how does that impact the trajectory of a new token project? And then finally, I want to cover kind of something I'll call the liquidity maturation curve, because I think it's an important concept in understanding how any financial asset, whether it's crypto or it's equities or whatever, kind of like actually gains liquidity in the market. Okay, and then finally, I'll talk a bit about the November cohort that we have for Botcamp, which is basically a 6-week boot camp that we teach, where we teach market makers and folks who are trying to build custom algorithmic trading strategies with Hummingbot. So first, a bit about me. This is if you want to follow me on socials, I'm Fatality on Twitter and I think Telegram as well. So feel free to send me a DM. I'm actually quite open to just like getting DMs and just responding to users on Discord. So if you join a Hummingbot Discord, that's kind of where I hang the most. But my background is I spent the first 9 years of my career in traditional Wall Street finance, working in New York and Hong Kong. My specialty was structuring these things called CDOs, collateralized debt obligations, especially the ones backed by subprime mortgages. I guess my claim to infamy is that I structured the first Excel model that was used by Citibank to create the first subprime mortgage-backed CDO in 2002, and it was subsequently used for many of the deals afterwards. But anyway, I felt quite bad about this actually, because it actually did kind of like I got into it because I really loved the concept of like financial engineering, creating new paradigms in finance and kind of allocating risk reward. Okay, and then finally, just continue on. So about 14 years ago, I got fed up with the whole industry. I came to Silicon Valley, and I kind of like my first startup was acquired by a company called Nitro. We were doing kind of like basically extracting tables from PDFs using computer vision, 10 years ago. So it was a very ambitious startup, but it was acquired by Nitro, where I was kind of like lead product for a while. And then about 2017, 7 years ago, my friends and I formed a company called Coin Alpha because we wanted to try to kind of like take the blockchain and use it to create kind of more efficient versions of hedge funds. So we created an early hedge fund that was basically built using Ethereum and smart contracts. And then we created a protocol called Fund Protocol that we were trying to get other hedge funds to use it. But then, unfortunately, one day we got a letter from the SEC. They asked us to shut down the fund. And then so one thing led to another, and we ended up open sourcing our software stack and writing a white paper about how people might use this open source software to do market making. At the time, it was actually initially funded by a grant from 0x, who we're still very much close with today. And the reason they funded it was because they wanted needed liquidity on an early decentralized exchange they built called Radar Relay. And so we built an early strategy called cross-exchange market making that allowed people to essentially run a strategy that would make a market on Radar Relay while hedging their risk on Binance. And so that strategy became quite popular, and it became used not just on Radar Relay, but other smaller exchanges who wanted the connectors added to the code base. So over time, Hummingbot has really kind of turned into a community project where a lot of the contributors today are basically the folks who are maintaining their own exchange connectors and other folks from the community who are adding their own strategies as well. So this is what the usage looks like currently for Hummingbot. We've seen about $6 billion of volume over the last 6 months or 3 months. We track this in our public volumes dashboard, but overall, the number of users we actually don't see very large because most of the folks running it, I think it's still a fairly complex piece of software that really kind of like developers, quant traders, and folks who are trying to really become or using it for market making are using it today. So that's kind of why about a couple years ago we also formed a for-profit educational company called Botcamp that's run by the same team. And the goal for Botcamp is really to educate people on how to use Hummingbot to do market making for themselves and for their companies, and to kind of like essentially try to train the next army of Hummingbot users, and also kind of like help them succeed in their careers. And so I think we found actually a good kind of like balance between the open source foundation, which is really just intended to become kind of like sustainable as a foundation, and to try to farm as much work as possible to the community devs who are maintaining the Hummingbot code base, while Botcamp is kind of like is really there to try to grow the user base and try to train them up and help them build more and more sophisticated strategies using Hummingbot. So that's enough of the intro about us. And so the reason why I think I've become somewhat of an expert on market making is because Hummingbot integrates into many different exchanges, both centralized and decentralized, and a lot of both individual and professional market makers use it as a base of kind of like operations initially. So because of that, over the years, I've just talked to a lot of exchanges and market makers, new token issuers. So I feel like I have a good understanding of what the space looks like currently. I'll answer a couple questions. Yeah, one person asked what is Hashkey. Hashkey is an exchange. We think one of the reasons why the volumes are so high for Hashkey is because it used to be a fork. Now it's an official connector, but it's probably some larger trader or market maker that's using Hummingbot on the exchange. Now we actually don't control the reporting. It's really kind of like self-reported by the individuals using it. So we also suspect that some of the larger traders probably don't turn off that feature as well. I think it's important to understand that a job of what is market making, first of all. What is the actual kind of like let's define what it is first before talking about how market makers benefit from doing a job. So I think the traditional view of market making is that the market maker is intermediating two parties that are kind of like need to match. I think the classic example of market making is when you have two people, let's say Alice and Bob, and they have a coincidence of wants, which means that they want to exchange something and they're willing to do so at the same price, but they just don't match. They don't know about each other. And so you have someone in the middle that can match them. Could be an algorithm, could be a person. Then you can solve for this coincidence of wants. The trade happens, and both parties are better off. So how does this intermediation happen? Well, traditionally in finance, before the advent of computers, this was done very manually. So this is a picture of the kind of like the New York Stock Exchange. Basically, what you're seeing here is a picture of there are people actually standing outside the early New York Stock Exchange. So the New York Stock Exchange was this building, And then these people here were like the market makers who are making a market for small stocks, which were not traded on the NYSE. And then you had other people basically buying from them. And actually the NYSE itself was formed by another contingent of these market makers that only wanted to make a market for like the top, the blue chip, stocks, what we call the Dow Jones today. And so they had basically formed a building where they had set their base of operations, and then the other makers, their competition, basically just kind of set up shop outside on the street and were intermediating, people who wanted to buy and sell, shares of a stock. And so this kind of led to the classic kind of floor pit, examples you see of people who are, always kind of like doing that. Okay, so I think that if you understand kind of like the origins of market making, which is basically people standing on the street, helping people match and buy and sell each other. I think that the industry really hasn't changed that much from where it is today, because even though market makers today operate in rooms like this, looking at lots of screens, the nature of the job remains the same, which is you have lots of different assets that people want to buy and sell. Those assets trade on different exchanges all over the world. Those exchanges are both spot and derivative, so which gives you the ability to kind of like buy and sell individual quantities, as well as hedge the risk on different exchanges. And so the job of a market maker is still to actually buy and sell and allow people to buy and sell each other, solve the coincidence of one's problem. However, now you can do so electronically across hundreds, if not thousands of venues for potentially hundreds or probably hundreds of thousands of intercorrelated assets. So that's why the problem really becomes kind of more of like a mathematical, probabilistic, statistical problem to solve, combined with a lot of engineering in terms of being able to tightly integrate into all the different venues where you may want to provide liquidity. With Hummingbot, I think because we integrate to many exchanges and we have the same kind of strategy framework that an HFT proper trading shop have, I think we've kind of tried, we really have democratized this, so now the individual user can also use Hummingbot to do the same thing as kind of like, guys who are in a large trading operation like this. And also I think that's also coincided with the rise of smaller exchanges, lots of smaller token projects. So I think in some ways, Hummingbot, it really serves the long tail of exchanges and tokens. Let's go into more detail now and talk more about the job of a market maker. Understanding this job really helps us understand how market makers make money, as well as when you should and shouldn't hire a market maker. So in my opinion, the definition of a job of a market maker is something called price discovery. Price discovery refers to the transition an asset makes from something where it's completely illiquid, it's completely private, no one knows what the right price is, and it's not traded at all. And once it becomes public, once it becomes listed on exchange, once people start trading it, eventually it takes on a journey where eventually, hopefully, becomes something that's a public asset. A public asset is very liquid. It's widely held. There's a lot of people that want to trade it back and forth, and it's very transparent what the past price history is, how much volume is traded, and also where this asset can be traded. So this transition is, in my opinion, something that every financial asset makes, and market makers, their job is to basically bridge this gap and help an issuer turn a private asset into a public asset. And so, to me, what is success? Success is achieving something that looks like Bitcoin right now. So, if you look at the Bitcoin price chart, it looks like this thing is just rocketed up with a lot of volatility over the past 15 years. But from a market maker's perspective, the other side of this has been how many markets Bitcoin now trades on. If you look at each of these markets and how much volume and how much liquidity is each of these markets, each of these markets each player in these markets had to acquire Bitcoin in order to provide that liquidity, in order to trade that market. So in some ways, the rise in price of Bitcoin is also a rise in the number of markets where it's offered, and how much attention people are giving to Bitcoin, and overall, like, how many basically how much demand and supply there is that's being exchanged every day of Bitcoin. And so that's why I think a lot of the when we talk about success for a token issuer, it's really about getting your token listed in many different venues, especially the ones that are where retail traders are trading, and having kind of those coins be something that people want to trade. But because it's a competitive environment, every coin issuer is trying to get there. Only a few can achieve a Bitcoin-like scale. Okay, so so now that hopefully you define what that means, but basically what that means is that market makers actually serve a variety of customers, and they serve them in different ways. And sometimes it's not obvious if you just look at a market maker what kind of market maker they are. For instance, a market maker can serve asset issuers. Typically, these are people who want to issue a token. They go to the market maker for advice around the listing process, and in terms of providing the liquidity for that initial token. So that's kind of like the classic contract market making case. Market makers also tend to serve exchanges as well. Sometimes they have some kind of like contractual relationship with an exchange, or they have agreements with exchanges where they provide volume, and in exchange for providing X amount of volume, they get some type of rebate back. Market makers are also receive grants from blockchain protocols who want to grow their ecosystems, and who want to kind of like the market makers to support their decentralized exchanges, or to kind of like support the tokens that are being created on those protocols. And there's many market makers who don't serve anyone at all, because they want the freedom to trade their proprietary book. They're making enough money that they don't need customers. So I think I would say, in general, both large and small market makers, I think, pursue a variety of these strategies, which is why I think there isn't really a split in the market, in my opinion, between like a pure prop market maker and like a pure service market maker. A lot of market makers are somewhere in the middle. So that's why I think if you look at how market makers earn profits and make money, to me, I'll put it on a spectrum like this, where if you have a small market maker, the more prop ones are probably running more like a mid-frequency bot. This is what Hummingbot's really good for, where they're running bots on kind of small exchanges, on less crowded trading pairs, or providing liquidity for a new token, and they're trying to just basically make money that way, or they are making money by providing more of a service, either generating volume for a protocol or an exchange, or earning liquidity mining rewards by providing liquidity for a token, and earning some type of airdrop or other reward. I think as market maker becomes more institutional, and this can be like a 2-person shop ranging to like a 1,000-person HFT shop, then they tend to use much more custom hardware and software, because they're trying to compete in the biggest markets, like Bitcoin USDT on Binance, and they're running much higher frequency bots and trying to do things like MEV, arbitrage and those kind of things. The larger players also tend to be the ones that are really serving the token projects, and so there's kind of two models out there. There's the token option loan model, where they're basically getting tokens, and they're kind of essentially an option to buy them at a certain price, or they're kind of just fulfilling the market making contract and earning a retainer for providing liquidity at certain levels on the book. So if you look at kind of like how you should hire a market maker, I think if you do need to hire a market maker, I would actually think about these kind of like 4 levels of like, what are the different terms people might offer. So as I just alluded to, the main difference in model that are offered out there by market makers is what's known as the monthly retainer model, where a market maker charges a few $1,000s a month for providing the service of providing liquidity. or the market maker is not charging or charging a minimum monthly fee, but what they're getting is they're using your tokens and they have an option to buy them at some strike price. And so they would benefit if the token price appreciates a lot, and so in theory, in the option model, they are aligned with the issuer's kind of like desire to have the price go up. However, in practice, I think some projects have learned that the option model introduces perverse incentives for the market maker, and so especially in a scenario when the price doesn't go up, and so that's why I think a lot of folks have started moving over to the more vanilla retainer model in the last couple of years. But I think a lot of market makers still offer this model as well. Another difference is kind of whether the market maker uses their own accounts to provide liquidity, or whether they're using the client's accounts and just using their API keys in their bots. Usually there are kind of compliance issues in here, especially if you want liquidity on kind of like a more regulated exchange, let's say. But this is something usually you can negotiate with the market maker, and kind of depending on what your needs are. Another issue is kind of what assets are initially provided that are used to provide liquidity. One model is the issuer provides both the base asset, their native token, as well as a quote asset, the other asset in the trading pair, which is typically USDT or USDC. Another model is the issuer only provides their own tokens. The market maker provides the quote asset, the USDT, and the market maker is therefore taking more risk here. So typically, the market makers will only do this for token projects which are fairly large and kind of like where they can kind of depend on the price of the token being fairly stable after it's listed. And then finally, the way that market maker terms are generally quoted is that the market maker is committing to provide a certain amount of liquidity in terms of like open order volume within an X amount of spread to the mid price for kind of like basically like 99% of each week. And typically, so the market maker would have some reporting that is provided to the issuer either in real time or every period that tells them kind of how they're doing, whether they're meeting the terms, and so forth. But practically a large part of market making, especially for new illiquid tokens, is preventing kind of gamification. Because anytime you have an illiquid asset where no one knows what the price is, and you have a market maker that's committed to providing liquidity that people know is being hired to provide liquidity, there are adversarial bots out there that are trying to kind of like predict what algos the market maker is running and try to take advantage of them. So I would say, like, if you're actually looking at a market maker's performance, assessing whether they're actually losing your money for you or not is probably a very good sign or telling sign, because a good market maker should be able to take amount of capital, provide liquidity, and I would say not lose it very quickly. Usually you would incur some losses due to market making in an adversarial environment, but hopefully those are minimized. The next section I think is important to understand, which is the exchange landscape, because ultimately what issuers are really want to pay exchange or pay a market maker for is to help them navigate this tricky exchange listing landscape. The exchange landscape has really changed a lot, I think, in the last 7 years that I've been in crypto. And I think really, like, when I first got into the industry, the idea of a decentralized exchange was just like a thought and a prayer. And I remember I was on a panel, I think in 2018, where someone was trying to predict like the annual volume of DEXs in like 2023. And I think the top answer was something like 500 million. So we're actually now in a situation where DEXs are actually, achieving a meaningful share of the volume now. So it's probably something like 10%, maybe 5-10% of SEX volume. But to me, the difference is actually, if you look under the hood, it's actually quite interesting, the differences between SEXs and DEXs. So you just kind of look at a CoinMarketCap or CoinGecko. What you see is kind of like they kind of rank exchanges this way, where they say, here are the centralized crypto exchanges, Binance, Bybit, etc. And then you have the decentralized ones like Uniswap, Orca, and so forth. To me, I don't like this distinction because I think there's actually more interesting variations happening here. Because if you look at kind of like the centralized exchange landscape, there's actually kind of two big types of centralized exchanges right now. So you have the kind of like the traditional centralized ones like Binance, OKX, and Coinbase that are basically they're private companies. They're managing the data themselves, and when you send them your crypto, you are sending them into their wallet. You're basically trusting them to keep your crypto safe for you. And then in the last couple of years, there have been the advent of kind of like order book based decentralized exchanges where the assets are stored in a smart contract. There's still a company that's operating the front end and typically, like it's charging fees and basically operating like normal exchange. But the difference is, at least in theory, this should be more trustworthy because the assets are stored non-custodially in a smart contract, either in their blockchain or in the case of Drift on the public Solana blockchain. So I think especially this year, we've seen a lot more users start using things exchanges like Hyperliquid, in large part because of the ease of use of DEXs has improved a lot. Where now it's almost sex quality. And in addition, I think because of geographic restrictions on a lot of the sexes, especially to trade perpetual markets, people have migrated over to the DEXs. But overall, in terms of the actual structure of the order books and how the markets function, there isn't a lot of big differences between trading on a SEX versus a DEX. The main distinction is a type of market you're trading. Is it a spot market or a perpetual futures market? So I'm not going to go into a lot of detail on the differences between these markets, but there's quite a lot of documentation on the Hummingbot website if you want to learn more about the differences here. So before I move on, I want to address one question that Leon asks. He said, biggest question as an exchange operator, how to make a market on one directional exchange, primarily full of sellers, not buyers, and needing to fulfill the role of the buyer. Is this possible, or all market making strategies involve another market to hedge or leverage against? So yeah, I think that question is a great question. I'll probably cover in more detail at the very end. But I would say if you're market making as an exchange, which means you can choose which trading pairs to offer. This I'm assuming you can choose. Then you probably want to offer something you can hedge, probably the most liquid pair you can. It's also because those are probably the ones with the highest demand for people to buy and sell. So for example, Bitcoin, if you can. I think it's different as a token issuer when you're forced to list. If you have to list your own token, and then you have to kind of generate demand, buying and selling for your own token. However, as an exchange, my biggest recommendation is if you're going to try to create new markets on your exchange, you should try to do so always with the most liquid tokens possible. So I think in terms of getting back to the difference between exchanges, if you look at the decentralized exchanges, I think it actually becomes very interesting the number of patterns that have emerged. So, but when Uniswap first came out, I think in 2019, it was what they call the V2 model, and I think today Radium, one of the top DEXs on Solana, still most of their pools still use the Uniswap V2 model, where it's a simple pool where it's structurally it's always half of the base asset and half of the quote asset. And so when you deposit assets into the pool, you have to deposit exactly a 50% ratio in terms of value of base and quote. And when you withdraw, it's also how much liquidity you can withdraw as well. So overall, so essentially it's kind of like a linear order book where the liquidity provider or / market maker is exposed to kind of like any variation in price, but you are getting the fees, for creating that exposure. So unlike a centralized exchange where when you do a trade, you pay the exchange fees on an AMM DEX. If you're providing liquidity, and let's say the fee is 0.25%, whenever a trade happens, the bulk of those fees go to you as the LP. That's basically your LP's kind of like, that's why you want to do the LP in the first place. As the market matured for AMMs, eventually Uniswap introduced V3, which allow you to a bit more flexibility as an LP. So now you can define a price range, and you can concentrate your liquidity in that price range. And then now now you can kind of essentially have more flexibility in setting that. So today, I would say most of the liquidity on Uniswap has become this V3 model, and now even on Solana, all the DEXs, including Radium, have adopted the CLMM model as well. But Orca for these like CLAM or CLMM pools is still the more dominant platform on Solana. And then recently, Uniswap also announced the introduction of something called V4, which allows people to create more sophisticated types of pools and other things in them. I believe it's going to come out in I think October or November this year. But on Solana, there's already an exchange called Meteora, which kind of like has used a similar kind of pattern. And then the main thing it kind of allows for is, instead of having your liquidity in a kind of like evenly distributed throughout your price range, you can now essentially optimize and select the distribution of liquidity within that range. And so now it kind of basically offers an LP more flexibility in terms of like the type of liquidity distribution they want to create. So overall, I think what's interesting is that if you look at the exchange landscape today, the DEXs have definitely started taking market share away from the SEXs on both the order book side, with Hyperliquid coming up, as well as on the AMM side, with kind of these DEXs being used more heavily now on both Ethereum and on Solana. But I think, to me, it's really about having AMMs and order book exchanges serve different purposes for different types of assets. So by that, what I mean is, if you look at the this chart here, which shows the new tokens by blockchain, you can see also like the number of traders by DEX, and also the volume. I think to me it's plainly clear that the purpose of AMMs is really to enable price discovery for long tail new assets, because the rise of these new tokens being traded, and kind of like how now every single week you have hundreds of thousands of new tokens being created on the blockchain. This rise in new tokens has coincided with the rise of trading on AMMs, and I think if you think about it, it kind of makes sense, because right now you have all these small players, retail traders, and folks creating coins, mostly meme coins, and then so there's no institutional market makers for them, and therefore the only folks stepping up are the small LPs as well in these Uniswap and Radium and Orca pools. So that's why in some ways I actually find this quite encouraging, because to me it's about kind of like, now we're really seeing the democratization of both asset creation and market making across the landscape. So so let me answer another question from Alex. Can a market maker realistically profit on a risk-adjusted basis from providing liquidity by trading on their own account, given the losses from fraud, smart contract vulnerability, exchange fees, and regulatory environment? I would say it's hard to answer that question deterministically, because every market maker has their own local jurisdiction and everything. So if you think about it, if you're a market maker that's based in the U.S., for example, and you're operating under U.S. rules, you're probably going to be outcompeted by a market maker in a less restrictive jurisdiction if you can access the same markets. So this is actually one reason why a lot of market makers are not based in the U.S., for example. But I think that another thing is, I would say, can a market maker realistically? I would say it's proven by the fact that there's a lot of both individual and small market makers out there that are doing quite well. But unlike in traditional investing, there's not really a huge incentive to kind of like talk about how well you're doing because it just attracts more competition. But yeah, I would say to answer your question, the fact that we're seeing billions of dollars of volume traded by people using Hummingbot is, I would say, is a pretty clear indication that they're not losing a ton of money by doing so. But in general, I think I would say generally the markets are always correct. So it's usually a mistake to assume that if people are throwing billions of dollars at a market, that there a lot of people are losing money. Because usually finance is zero sum. And so what I see here that this chart shows me is that I would say, there are certain traders who are losing money, but a lot of folks who are creating these tokens are actually making money because these are 100,000 tokens, and if only a few of them kind of like reach the stratosphere, then at least it offers a hope that everyone else can do the same thing. So that brings me kind of like to my final kind of a more academic subject, which is something I call the liquidity maturation curve. And I think understanding this curve is really important to understand, whether you should even engage a market maker and what role the market maker is serving for you at that point in time. So what I mean is, liquidity maturation is essentially, as I mentioned before, every financial asset has to go through this price discovery process of going from a private asset completely held by insiders to one that's widely traded by everyone. So we can actually break down the stages of that curve a bit more. So here's how I would think about it. First, you have a private asset, which is not tradable. It's not listed anywhere. It's only held by the founders, early investors, and by no one else. And then there's some point in time when the asset starts trading on a market. So that's when I call it's being newly listed. And that's when the market basically, with every trade that happens, becomes another data point on the future potential trajectory of that asset. And there's initial price discovery that happens. So what I mean is, that's why when every single asset that starts listing on exchange, the price is very volatile for the first few days, maybe for the first week, for first few weeks, and then eventually settles into a pattern where now there's some correlation between that asset and, let's say, the broader market, reflected by the correlation between that asset and maybe the price of Bitcoin or the price of Ethereum. This initial price discovery process is when an asset starts trading in a range, and now market makers, and now the asset might be listed on multiple venues. Once it's listed on multiple venues, a market maker can now hedge their operations, and the more liquidity is out there, the more the proprietary trader market maker types get more interested, because let's say an asset's traded on 5 different venues, and if there's like arbitrage opportunities between them, now a market maker, even if they don't, even they're not getting paid by the issuer, might step in and arbitrage those markets against each other. And so overall, and so the more listings the asset has, essentially it's a new place that kind of needs to acquire some of the asset and create some trading activity. And if that does result in trading activity, typically people want to add more liquidity, and then the asset, almost by definition, kind of like should rise in demand and price if it all goes well. So what I painted is like a happy path of what kind of adoption looks like for any new financial asset. But the end goal is typically to have the asset traded on all major venues and for it to be adopted by mass retail traders. So here's what the liquidity maturation curve would look like for stock. So let's take Uber as an example. And Uber was funded by a VC firm called Benchmark initially, I think in 2010 or 2011. So they're public, or they're private, I'm sorry, for about 7 or 8 years, and then they went public in an IPO led by a U.S. investment bank called Morgan Stanley. So Morgan Stanley, because they did the IPO, they're paid a really hefty fee. That fee included both the underwriting process, so kind of helping Uber, figure out which exchange they should list on. I think they picked an NYSE, and then also how to structure the deal in terms of which investors might buy it, doing a roadshow, figure out the price. But Morgan Stanley's job also extended into providing liquidity for the Uber stock after it was listed on the NYSE. And so you see these people here. This is in the kind of like the days when floor pit trading was still a thing in equities. So you see these guys here. They're basically Morgan Stanley broker dealers who are in charge of trading the Uber stock. And so after Uber becomes more popular, the stock, of course, is it's a because it's a name brand, it tends to be something that people want to buy and sell more. And now today, Uber is kind of like now it's included in the iShares ETF, and now it's being purchased by lots of people whenever they buy this ETF, which includes pension funds as well as retail investors and the mass public. So this journey of going from a private asset to a public asset, I think, happens in the equities world, and I think it's not that different in the crypto world for VC-backed tokens. So typically, the trajectory for a VC-backed token would look something like this, where it's typically funded by a crypto VC, and then after they create a token, they typically hire a market maker to help them navigate the process, figure out which exchange they should list on. After they list on the exchange, kind of like having the market maker provide liquidity, support kind of like various initiatives in terms of like the token issuer might do, and a lot of that is adding more exchange listings, and then eventually, hopefully, after efforts from both the market maker in terms of providing liquidity, as well as from the token issuer in generating demand for the token, eventually the token achieves a top coin ranking, and at that point, maybe there's enough organic liquidity volume that the market maker is needed anymore, and the coin project cannot hire the market maker. I should point out that this is an ideal path. Many tokens, because there's many tokens being created, being funded, being listed. Many tokens never get to this stage, even if they achieve a Binance listing or Coinbase listing, because usually achieving a top ranking is not just about where you're listed on, but how much attention, how much demand you really are getting from the retail trader base. But I think there's actually a different paradigm has emerged in the last few months, and I think it's actually interesting because if you look at how meme coins kind of navigate this liquidity maturation curve, it's very different from how VC projects are doing so today. So if you take Solana as an example, typically a new meme coin starts off on a platform called pump.fun, where it's a very degen platform where people are creating all kinds of coins. So here's one called Smoking Chicken Fish, which was created I think a few months ago. And after there's enough people that kind of like kind of buy the token on the bonding curve, I think it's about $50,000 right now. The liquidity, it kind of graduates from pump, and the liquidity gets locked up in a Radium pool. So this is a standard Radium pool. This is what this is the V2 style AMM I referred to earlier, that I guess now people are calling the constant product market maker. So the reason this is a standard pool is because these pools are really good at initial price discovery. No one knows what the price really should be, and so if the liquidity providers in this range are just taking exposure to the full range from 0 to infinity, and they're getting paid 0.25% every single time people trade it. And so if you do happen to be an LP in a pool like this, and and this token does go up a lot, you actually do benefit a lot from both the fees as well as the potential price appreciation. However, you also go down the other way as well. If this token turns out to be a rug and go to zero, an LP in this pool also would see their LP position also go pretty much to zero because it all gets converted into kind of like one side, so to speak. So after this initial price discovery phase, let's say this SCF token is trading, there's demand for it, and it's kind of settled into some type of price range. Then typically what you start seeing is people will create CLMM positions for the token on Orca, Meteora, and other platforms, where these are pools that allow people to more closely define the range of price where they want to provide liquidity. And then after some time, if there's enough interest in the retail public in trading this new meme coin, eventually Binance or some larger exchange would just simply list it proactively, because these coins tend to be, I would say, they're more popular in terms of trading, and therefore, if there's tens of millions of dollars of trading activity every day for a token, then it could be very lucrative for exchange to list a token and to get it. And so typically when this happens, the exchange also has to buy some of the token in order to create the market for it. And so it also acts as a catalyst in terms of demand as well, if a token is being listed on many different venues. So this again is the happy case for meme coins. And of course, it's not every coin is going through this. But to me, I think what this actually exposes is to me actually I think it's actually interesting how AMMs especially are being used for price discovery, because if you look at the prior kind of like the meta for VC coins, a lot of token projects are paying a lot of money for this initial order book listing. They're hiring market maker, paying the exchange listing fees, and they're typically doing so on a second or third tier exchange. And then if they want to add more listings, it typically gets more expensive because they're hiring market makers, for more exchanges, and the cost really kind of is increasing. And so to me, if I were issuing token today, I would actually explore basically the AMMs on my native chain as a form of like cheap and efficient early price discovery, because it's kind of like, because if the goal is eventually to list on Binance or Coinbase, then in my opinion, you want to kind of like navigate this part of the liquidity maturation curve as efficiently as possible. And if you can kind of like just create a few pools somewhere and kind of achieve a trading history for your token, it actually makes it much easier, I think, to list on afterwards. So that's why my advice for token issuers would be, definitely, engage a market maker if you have the money to do so, and you want to list on, let's say, Coinbase, for example, but you might be able to use AMMs to kind of like skip some of the early parts of the maturation curve. Okay, I'll pause here. I want to kind of go over a bit more and really give a preview for our Botcamp November cohort. But let me give you let me answer a few questions here from but Dan Ho before we move on. So he asked, what would be the question? What would be the reason to hire more than one market maker? So that's a good question. Let me just handle that. I would say one reason is for if you're a larger token issuer and you want to list on, let's say, multiple venues. Some of the venues might be more regulated, like Coinbase. Other ones might be DEXs like Hyperliquid. And so some market makers just might not be able to do the job of providing liquidity on Coinbase for regulatory reasons. Other ones might not be able to do the job of providing liquidity on Hyperliquid, or let's say Uniswap, or managing kind of like Solana DEX positions more because of technical reasons. So I think it really depends on from an issuer's perspective, what are their needs from market makers? What are they from a liquidity perspective, and how do they achieve that? But typically, I would say, unfortunately, a lot of token projects think about hiring market makers as like these financial wizards who can kind of like help them kind of with anything they want. And typically, market makers are really just there to provide liquidity. But to me, what I would look for in a market maker is really the ability to provide honest advice about the realities of the market, what they can and can't do, and hopefully they're offering like kind of the advice that's best for the token project, not for themselves. He also asks, what are the reasons that the loan option model exists at all? That is, why would be mutually beneficial in some cases over the retainer model? So yeah, I do think the loan option model, I guess like it's mutually beneficial in some way if the token price goes up a lot. Now if the token price goes up a lot, the token issuer actually is paying a lot in terms of the optionality to the project, to market maker. But if a lot of times token projects kind of assume that the market maker, if they have a big incentive, they can influence the price. That's actually not true typically most of the time. So, but I think the reason, in a nutshell, the reason it exists is because it seems cheaper than the retainer model because there's no kind of upfront monthly payments, and it seems like the market maker is in your favor. But my general advice is if an HFT firm that really understands the market is trying to sell you something that it sounds too good to be true, it typically is. So that's all I always say. So yeah, I think Behendo has more details on the loan option model. I'm happy to go into this more detail later on if people want, but I don't want to get too much into the weeds in terms of like one model versus another in terms of market making and how people pay. So let me go over a bit more our November cohort for Botcamp. So Botcamp, as I mentioned, is our kind of school for market makers, where we essentially we try to take people through a 6-week period. We try to train them in both the theory and the practice of market making through a lot of hands-on online live sessions. And so it typically looks like this, where either me or Fede, our CTO, we walk through sharing our own strategies, how we run our own bots, and teaching people how to use Hummingbot to design their own strategies. We just did a demo day. So if you look on YouTube, there's a video that shows what people presented. And in the last batch, we started to introduce the concept of adding LP strategies. So I think it'll be interesting to see what people build in this next cohort as well. What's new in cohort 10 is we're offering 2 different tracks of live sessions and for certification. So one track is the traditional strategy developer track, where people get certified in coding a custom strategy using Hummingbot. And so to graduate and attain that certification, you need to design and code a Hummingbot script and controller and submit the developer template and a video explaining what you did. So typically this is what we play at demo day. And then we're also offering something called the Market Maker certification. This is for folks who are not as technical, but they still want to get into market making, learn how to run a market making bot using Hummingbot, or place and maintain positions on AMMs like Radium or Orca. And so the requirement to graduate is to implement a market making strategy using Hummingbot or using kind of like our new DEX focused tools, and operate a strategy, basically operate a strategy, run it, and then analyze kind of how that strategy performed in a video. So the way that we're doing it is that basically each week we will have 2 live sessions. Fede will conduct the strategy developer sessions, and I will conduct the market making focused, more theory kind of sessions, which are also on chain, which kind of covers more like the on chain topics. And I think, and in addition to that, we'll also offer office hours starting in the 2nd week with Huang, me, and Fede, where we can offer a bit more customized help for students. So we're hoping that this way people can learn both the dev side and the market making side, or both if they want, and kind of like basically so they can like we have like tracks for both non-technical and technical students alike. But both students in both tracks, ideally, we want them to submit their video for demo day so they can present what they built to everyone else, and then we give them a certificate to everyone present the demo day. So with this, we also want to encourage people to kind of like sign up early on. So we do have early bird pricing, which ends in 4 days, which is about 2,400. And then our regular student one is 3,000. Overall, we've heard from past students that we're offering good value in terms of the content we teach, as well as kind of the hands-on help we give students versus the other trading boot camps that are out there. So you can use this link to sign up. I'll drop this in the chat. And also, I want to also call out, we're testing out something where if you pay with, you basically use Helio to pay in USDC on Solana, but you can also use Helio to create a personal kind of 10% affiliate link where, if anyone else buys a Botcamp cohort, you get 10% of their payment. And we're testing this out with some folks in our Botcamp who've tasted before, but it's actually open to anyone that wants to refer their friends into Botcamp. So yeah, that's it for the live part of this presentation. Let me just drop these links here in the chat, so you guys have it. So here's the registration link, and here is the Helio kind of like the affiliate link. But basically, they both like basically allow people to register. So we anticipate something like 20 to 30 students in this cohort. We'll try to keep it small because we try to offer a lot of personalized help. But overall, yeah, I think we do want to grow these cohorts next year. We'll probably announce kind of the full schedule so people can sign up for any cohort throughout. We'll probably offer 4 cohorts next year. And we'll try to get more organized around. Prostute asks, if I were a DeFi project in Solana and I want to launch a token in the near future, how should I go about it based on the current status quo? Achieving some type of organic demand for the project. Yeah, it's a great question. So I think overall, I would definitely, especially on Solana, I would probably try to do so simply using the tools available in Solana. So I think how you launch a token is a more complicated subject than just like how do you get liquidity for a token, which is really what market making is. I think, and the way I would think about it is, I think you want to ensure that your token has support on both the maker side and on the taker side. So I think that using launch pads and those kind of things are really good for generating taker demand, because let's say you go through a launch pad like Jupiter, hopefully Jupiter's helping doing marketing for your token, and they're getting more people interested in learning about what your token is, and potentially retail traders or basically takers buying selling token. Now, when those people buy and sell your token, they have to buy it from someone, and so the question is, where are they going to buy it from? If you're in Solana, and I would probably initially, the very first thing I would do if you're going to launch a token is probably creating a standard pool. You can undo probably Radium is probably the simplest place to do it. Where so if you create a pool in Radium, especially if you lock up your liquidity as a signal to the market that it'll be liquid. Now, when someone buys and sells it, the slippage will not be very high. And so then what you may want to do is, now that the price is kind of, once the price kind of settled into range, you may want to ask your investors to, or yourself to create a pool in Orca, and to kind of like, further add more liquidity in a more concentrated price range, and kind of go from there. So I would definitely consider, if you're in Solana, just leveraging Radium, Orca, and Meteora to get liquidity. And then you can also kind of like, if you want to kind of try to do more automation around liquidity provision, look at things like Camino and Hawksite to create these like kind of more like LP strategies that people can just deposit into your pool. Yeah, so basically, if I were a token issuer, I would definitely explore the AMM options on my native chain, and just just like create a pool for like $5, just to see like is there demand, because it kind of helps you verify based on the market, is there demand for your token. Like what happens if the price goes up and down. And so obviously you want to, if you are VC backed, you have investors, you want to kind of stage that in conjunction with your investors, so they know what's happening, why you're doing it, can they add liquidity, should they add liquidity, all those things. But I think if you do it correctly, I think it actually almost gives your investors like a use case for the options, because instead of holding it in their wallets, now they can deposit it into a pool and earn some swap fees from it. Hello, but Badejo, yes.
Awesome. All right. Well, thank you first of all for this info session. My question is, I noticed that a lot of market makers advertise that they support like 50 or 100 exchanges, but then I noticed that Hummingbot has like relatively few connectors. Does that reflect the difficulty in maintaining a lot of different exchanges, or is it just like the focus of Hummingbot is just a few
Yeah,
use cases? So it's
yeah, it's a great question actually. So the we actually see a lot more exchanges than what we list officially in the code base. That's why we see about 150 being used out there. The reason there's actually a governance process to decide which exchanges are in the code base, because if it's an open code base, then we try to keep it up to date with the standards we have. So in some sense, we actually don't want to support. We actually want to limit how many exchanges we support, because it's like each one, because people are downloading the open source software and using it. And so if there's a security issue with some of the code on one exchange, it might impact everyone using the code base. So we actually take a lot of care in reviewing the pull requests that people submit for each, especially related to connectors, because we want to make sure that each connector in the code base, the code related to its integration is needed only when people want to use it. So we actually try to kick out exchanges through governance every quarter if they don't meet a minimum threshold in terms of HBOT voting. It's because that allows us to have a cleaner master code base that people can use, and that allows us the framework to evolve more kind of like more organically. But a lot of people just maintain a fork of Hummingbot, just with their own connector for private use, and we're totally fine with that. But we actually try to make sure that the master branch, which just has the official connectors, is the one that continues to evolve and is like reliable for everyone.
thank you.
Yeah. Question from Fari: is basic knowledge or advanced Python needed for strategy developers to join the cohort? Not anymore. It used to be the case that to earn the strategy developer one, you had to kind of like have like more advanced Python. Now it's easier. You can actually build. We've had people who build scripts even with a very basic level of Python knowledge. I think that's also why we added the market maker track, because we know that a lot of people out there want to learn market making, and you can actually use Hummingbot and learn market making without knowing Python. So the market maker track is really designed for people that they want to learn market making. They might actually want to like even make money by market making, getting to the business of it, and they just need to learn how to operate the machine, so to speak, not how to customize it. Leon asks, what is the average ROI that the average market maker achieves? Is it relative to capital? How much capital would be a recommended amount to make a living off market maker if it's possible at a retail level? It's a great question. We get this question a lot. So I think it's actually very difficult to talk about the average ROI, because like in any type of trading, you have people who are doing well because they invest the time, the resources, and they have some type of edge that they've proven out, or you have people that are just gambling. And I would say, I would say on average, I would not be surprised if market makers are probably losing money, because a lot of them out there are just kind of gambling, and as the market turns, they're gonna lose money, just like any type of trader. But so the way I would think about market making is, I would say if you want to get into it, you can probably start testing it out with a very small amount of capital. You should probably expect that initially you're probably going to lose some money. Not a lot, but at least but hopefully you're learning about why you're losing money or why you're making money along the way, so that you're eventually achieving some level where you feel like you are beating the buy and hold. So that I think that I think that the easiest way to do this, I think if you think about kind of like from the on-chain, let's say taking on-chain for a standpoint, is if you hold let's say Ethereum in your wallet right now, and you do nothing with it, you're basically earning 0% yield in Ethereum. Or you can take that Ethereum, you can take that and plus some USDC, and you can put it into an LP range, and you're taking some permanent loss risk, but you're also earning some swap fees along the way. Alternatively, you can also take that ETH, you can stake that into Lido, or you can lend that onto Aave. So each of these things are something you can do with your ETH. And so if you measure return just in ETH, then you probably outperform holding in your wallet by either staking, by providing liquidity, or by lending it out. And so I think that's why, like, when you look at like kind of like ROI, I think the first thing I would say is start small. Try to identify, like, start with the most conservative approach you can in terms of like using your capital in various ways to earn a yield. But then in terms of assessing risk, what I would assess is not just how much money you made, but like assess how much money relative to some base asset like Ethereum, USD, or Solana, and then also assess how much risk did you take for that given amount of capital return. So let's say if you park your assets in some risky lending protocol, and let's say you make like a 5% yield, and then you pull it out after say 6 months, and if you would have made more money by just putting your money into treasury bills or putting money into a bank account, then that's probably so like I think it depends on what the alternative for the capital you want to use is. So that's why I'm taking a long time to answer your question, Leon, because I think that it's never as simple as put money in and achieve ROI. I think in whether it's market making or any type of kind of like competitive sport, so to speak, it depends on how much I would say how it's like do you actually have an edge, and can you actually kind of like identify that edge and keep on exploiting that edge until the edge goes away, and then you have to go and find another edge. So typically, I would say it's actually a lot of work, whether it's market making or algo trading, to even identify if you even have an edge in the first place. So yeah, I hope that helps. But I would say it is possible to do market making at a retail level, especially nowadays with the advent of all these new exchanges, new protocols, new tokens. And typically a retail market maker is not making money strictly off of arbitrage or market making profits. Typically, the retail market maker is also making money off of some type of liquidity reward or airdrop they're getting from participating in that protocol. So Kevin asks, how often do the cohorts run? When will be the next one aside from November? So in 2025, I think we're going to use a quarterly cohort schedule. So we are going to post the sign-up forms for the cohorts, I think before the start of the year, so that people can register for any of them. So what we anticipate is that each cohort, I think we'll try to we'll cover more or less the same content, but we'll try to update the content each time to reflect the newest changes to the Hummingbot code base and other things we're introducing. We do have a middleware called Gateway that helps people run strategies on AMM's dexes, and so we'll probably be updating that repo, especially for the Solana dexes, and offering more strategies that people can do on chain using Hummingbot. So because right now the LP stuff that we're teaching is primarily just about the theory and helping people navigate the practice of setting positions on dexes. But we do think that being able to automate them using Hummingbot is going to be a big improvement. So Stephen asks, is there an easy way to calculate taker demand versus maker supply on a given pair? Yeah, I would say the simplest way to do that is to look at the amount of liquidity, which is kind of like let's say just like a TVL on an AMM, or like open interest or like amount of like order book depth on a centralized exchange. So that's basically the maker supply. So how much supply of liquidity is there for the trading pair. Taker demand is really just volume. How much volume was generated in the last 24 hours on the trading pair. So that's why I think that an easy calculation is for like an AMM or a CLMM is the LP yield that is earned. So the yield can be calculated as the fee level multiplied by the volume divided by TVL. So that's why I would say if you are doing LPing, I would recommend identifying pairs where there's relatively high volume plus higher fees, relative to the amount of TVL in the pool. So Alice asks, how prevalent is wash trading on new tokens? So I would say it's very prevalent because if you think about the incentives involved, um, new tokens are trying to stand out from one another, and one of the best ways to stand out is basically generating more volume than others. So I think wash trading is still very prevalent, especially because on many exchanges now, like on Base or Solana, or even on the centralized exchanges, the transaction fees are very low. So you can create a transactions for less than 0.0001 cents, and so it does encourage some wash trading. However, I would say I think that even though it does get a lot of attention, I think that it's almost like as a market maker you can almost ignore wash trading because ideally you want to participate. If you're an AMM, the wash trading is actually kind of good for you because it's still volume. But also B, typically the trick is to identify the coins where there isn't wash trading, where there is organic demand, because those are the ones that you want to own long term. Because ultimately, if you're market making for something, you're owning the base, a large quantity of the base asset, and so if you're holding an asset and market making for an asset where there is a lot of wash trading, it's probably a sign that the asset's probably going to go to zero at some point in the future. So you may want to change the token pairs you're using it for. So Tanis asks, for a starting single market maker, what do you think is a necessary starting capital? Can a small market maker make a minimum amount of volume required by many exchanges for MM classification and rewards without having large capital or taking risk with low capital? So it's actually not that much because of Hummingbot, in my opinion, because you can take, let's say, $100, run Hummingbot on an exchange, and depending on the strategy, you can turn over that volume quite a lot without losing money, especially if you can identify things like a zero fee maker promotion on certain pairs that exchanges offer. And so a lot of people use Hummingbot to generate a lot of volume on centralized exchanges with a small amount of capital, and they can kind of like achieve some type of like volume tier using Hummingbot. But I think it's also possible, I would say, to actually be a market maker on chain for even less capital, because you can create an LP position in a Radium pool for $1, or something like that, and just test out if you can make money off of $1, on a DEX. And so to me, I think I would actually recommend starting with AMMs, especially on Solana, if you just really understand the theory of market making, because if you set an LP position, especially on a CLMM like Orca or Meteora, it's very similar to running a pure market making bot on Binance or central exchange. It's actually very similar, I would say, to a grid type position on those exchanges. And so I think that there's something where I think if you experiment with LP positions on AMM dexes, it helps you understand the theory of market making better, understanding how to take, how to look at a price chart, identify a trading range for an asset, identify support and resistance levels and set kind of ranges which allow you to kind of profit from future price volatility, by earning yield, but you're not taking a directional bet on the price going one way or the other, which is really how market makers profit. Which is, they benefit. They usually make money when the price trades in a range, and their job is to kind of like get out of the way or kind of reduce their exposure when they feel prices are trending. I think yeah. Sir asks, where can I see all the capabilities of Hummingbot as a newbie? So I would say I think the best way to see this is we try to maintain a pretty extensive documentation site on our website. Here I'll put here, and then also I think our YouTube is a good place to just watch videos that people to see what people can do with Hummingbot. Yes. I think Steven was answering Tannis's question about watch trading. He says if you watch an exchange's trades feed versus order book, there's lots of exchanges spoofing taker orders. So sometimes exchanges would actually, so because exchanges they're just kind of it's not a very regular space. Exchanges, the centralized ones do tend to kind of like basically do a lot of wash trading, spoofing orders, which means like placing order book which aren't real, and also otherwise manipulating the market in some way. So as history, the ability for exchanges to kind of manipulate the market is kind of why the SEC came around in the first place. So they created the Exchanges Act in 1934, which enshrined the New York Stock Exchange as kind of the main venue for the U.S. equities market. I do think that selecting exchanges and which ones to trust is very important, having gone through the FTX debacle myself. But I think that's also why, in my opinion, decentralized exchanges will eventually capture more and more market share, because they can almost like prove through the smart contract that all trades are happening through the smart contract. All the balances are non-custodial on the blockchain, and so it's harder to do the same kind of spoofing that's possible today for central exchanges. So Leon asks, are signals of value to a professional market maker? Do Hummingbot strategies revolve around them, or signals of low to no value? I think what you're asking is what kind of signals are used by people in running bots. So that's actually a really good question. And so I'll answer that in kind of three levels. The first level is just using the data from the exchange itself. So what Hummingbot Connector does is it maintains the WebSocket connection to the exchange's API, and so you can have a real-time order book snapshot, as well as the what trades were done, and kind of other API endpoints like best bid, price, and those kind of things. And so typically the bot is making decisions based on data from that exchange or another exchange. And so that's why typically a lot of time what you would do is you would basically use two exchanges data like Binance and some small exchange, and so you might use the data from Binance, the signal from Binance, to as a true price, and make a marker around the true price on a different exchange. So exchange data is probably the first level. The second level of data is using some type of indicator based on historical data. That's why we introduced this candles feed concept a few releases ago, where now you can collect historical data from an exchange using Hummingbot, generate custom indicators based on that, and then use those indicators in crafting your strategies. And so that's the second level, which is kind of like actually creating indicators based on historical data. And then the third level of indicators are some type of external signal you're fetching from externally. So this is why we have our data feed class, where you can fetch and create essentially a custom data feed and use that in your strategy. I think one of the prior Botcamp students created a custom data feed based on the Binance liquidations API, and he's using that in his strategy. So so overall, I think the type of data, the type of signal you use in your strategies is very important. And so I think you can use either exchange data directly, some type of signal indicator, or an external API for this. So Tanis asks, yeah, I know Hummingbot supports EVM dexes, but does it now support Orca and Solana dexes? Not yet, but it will. Basically, on the Solana side, we realized that in kind of looking at Solana dexes, that the way that we designed the gateway middleware, which is how we support the EVM dexes, was not. I think the design could be improved. Mainly because when we first created Gateway, we didn't know what we didn't know. So I'm currently working on a new test repo. I'll drop it in the chat. It's only my personal repo, my personal GitHub for now, but it's aimed at kind of redesigning how the Gateway middleware works, aimed at supporting Solana dexes first. So we'll probably try to first support Orca, Meteor, and Radium. But the way that this repo is designed, it's not just kind of like middleware for Hummingbot, but it can also be used as a standalone basis as a CLI. So you should be able to go on to type commands and fetch your portfolio, fetch balances, and maybe even do some basic transactions using a CLI. And it can, and the same code is also used to create the API. So hopefully it offers like twice the functionality with like a quarter of the code base, and be simpler for people to integrate into it once it's done. But the idea is that that this repo will eventually, hopefully in a few months, once we've fleshed it out, standardized it, and incorporated some Hummingbot strategy into it, eventually this will kind of replace Gateway as like the middleware for dexes. Then Dav asks, what are the session times? So that's a great question. So the session times for Botcamp cohorts is always around this time on Tuesdays every week. So we pick this time. I think it's actually around 8 o'clock Pacific. It's about, I think it's in the late afternoon European time. It's early morning Pacific time / later morning on the East Coast US, and it's late night in Asia. So we do all of the live sessions around this time in order to try to accommodate as many people as possible from around the world. And then we try to post this live session recordings to the course that everyone in Botcamp has access to about 24 hours afterwards, and so they can see the recording afterwards. And then so the way that we interact with Botcamp is we add everyone to a set of private channels on our Discord, on the Hummingbot Discord server, and they can ask questions on Discord basically in real time. And Fede, me, and the other members of the team, and also the Botcamp community as a whole, trying to answer it. Overall, I think with Botcamp, I think we've actually tried to build a small, almost like a subset of the overall Hummingbot community that people were, everyone who's taken Botcamp has generally been more amenable to answering questions and helping each other out. Key features on our 2-year roadmap to look forward to, Leon. It's a great question. So I think what we're seeing now, the Hummingbot is starting to become more of a professional quality code base. We're starting to see more and more trading firms who are interested in kind of porting over some of their market maker operations over to us, especially since now we now support decentralized exchanges, and DEXs are becoming a more important part of the market making landscape. So overall, I think the main thing we're focused on in the last year, we've actually added a lot of new things on the UI and the strategies front. There's new dashboard, there's the Hummingbot library now, and also there's a new V2 strategy framework. I think in the next, at least for the next 6 months or so, I think Fede and I are really going to try to focus on reliability, try to make sure that all the new components we've added work with the exchange connectors, and that especially for the top exchange connectors, that they're reliable and people can run high, like sophisticated strategies, placing lots of orders, and have those bots run for a long period of time. So overall, that we're actually probably going to revisit potentially the connector architecture. That's kind of why I'm making changes to the DEX side right now, because I think the prior way we built kind of our DEX middleware wasn't kind of like like professional enough in terms of quality. So we're trying to improve the quality of the connectors in large part, because we think Hummingbot has a chance to become a standard for like open source exchange connectivity, and I think improving the connectors and allowing the community to maintain more of them, I think, is the way to scale for Hummingbot. So that's why I would say that's probably beyond that. I would say we definitely want to try to introduce improve the Telegram client. There's actually folks who are working on like an AI kind of based way to communicate with Hummingbot in a chat interface. So I think that improving the Telegram experience and allowing people to kind of control their bots using Telegram, it will be an important part of that as well. But overall, I would say, the main thing we're trying to do is try to improve the functionality of Hummingbot. For it's like you should be able to build anything you want with Hummingbot that runs on any exchange or any blockchain. So I think that the main thing we're going to try to do is evolve with the needs of the user base. So if people say, look, we really want support for options exchanges because we want to run these kind of strategies, then we'll try to create bounties for that and try to accommodate those kind of strategies. So overall, I would say, I think the roadmap is really about hopefully enabling market makers and algo traders to basically build anything they want using the framework. I'll take one final question before we end it. The last stage to register for cohort 10, that's going to be basically the first week that it starts in November. So the first date for cohort 10 is November 5th, which is a Tuesday. And usually we allow signups up until the end of that week, which is about November 10th or so. So I hope everyone enjoyed this session. We'll do this probably again before the next cohort starts in January, and try to maybe even have some folks from the Botcamp community share their experience. But overall, we want to try to do this more, just try to educate people on what market making is. Hopefully, even if you're not taking Botcamp, even if you're just interested in how the industry works, this session can help shed some light on this shadowy area of crypto.
Hey, Mike, one last thing. For people that have already taken Botcamp, isn't there like some sort of preferential thing where you get nice pricing for continuing education as things evolve?
Yeah. Actually, I'm really glad you mentioned that. Yeah, thank you for reminding me. Yes, for Batch Botcamp, if you've taken Botcamp before, we offer basically like $1,000 off any new cohort. So because we want to try to encourage people to take more. So I think I would say I think this time we'll probably do a custom one. So I think if you're interested in taking it again, please DM me. But I'll send out an email to the Botcamp listserv today or tomorrow with information on how you can use a custom code to get $1,000 off the next cohort. Also, we are also offering a team plan. You can get basically 3 seats for the price of 2. We'll also kind of publish more info about that on our website. I apologize. Currently, I think the registration page for Botcamp Cohort 10 is not updated right now. So it still shows some outdated content, but we'll try to get that updated with all the materials I just talked about in the next few days. Well, thank you, everyone. I really appreciated this chance to just talk to the community and try to answer questions. And we'll do it again, probably after the next cohort, probably near the end of the year. Bye, everyone.